Number 1, do not expect to get rich quick. Investing in the stock market is a marathon, not a sprint. It is a persistence game that takes time, compounding, and dedication. Now, even though a stock can go up or down 20% in just a matter of an hour, remember that at the end of the day, you are investing in a company, and change within a company takes time. Sometimes it can take years and even decades for a company to effectively improve its business fundamentals. If you want to make money investing for the long term, you need to identify companies that will improve their fundamentals over the long term. This fundamental improvement can be done through multiple different avenues. The first being through expansion of revenues. This can happen through the company increasing its customer base, selling more products to its existing customers, increasing its pricing, or even lowering its costs, thereby improving said product's margins. Now, you might be thinking to yourself, Alex, I have no idea how to identify that. Of course, there are many complex ways of identifying these opportunities with much more precision. After all, I didn't go through my bachelor's degree in finance for nothing. But by simply using common sense and by opening your eyes to what's around you, it isn't particularly hard to identify trends that will meaningfully last for years and even decades to come. Which leads me to point number 2. With research comes confidence. You're not going to get away with it that easy. By having done your research, it will ground you in moments of uncertainty. Knowing what you own will put you in a position of strength in the face of incoming information to be able to filter what's relevant and what isn't, what's fear-mongering versus what's actual real news. Which leads me to point number 3. Do not be afraid to be a contrarian. It's okay to not invest alongside the rest of the crowd. In fact, most of the time, the crowd is wrong. And by forging your own conviction through your research, it will often yield better results. A stock is not necessarily a buy just because someone else is buying it. Whenever I see an unusual amount of hype and attention surrounding a stock, it usually makes me very skeptical. And although it is almost a certainty that throughout your investment career, you will encounter instances of extreme FOMO buying and crowd herding, leading to self-fulfilling prophecies and positive feedback loops where these stocks increase in value, which then catches a lot of other people's attention who want to get in on the action, who then pile into the stock, thus pushing the stock to even higher levels. These can represent great short-term opportunities for people to make money. However, there's a really important distinction that needs to be identified between speculation versus investing. If you are an impressionable individual who tends to get lured in by all of these promises of great wealth, then you just need to be aware of the risks that come alongside that type of speculation. It's definitely easy, and trust me, I've been in that position, to fall into the cognitive bias of thinking, well, I'm different than the others, and the stock is going to go in my direction, even though I haven't done any research. If you are new to this game, it's just important to be aware and to know the risks that come with this kind of gambler's mentality to the stock market. Just be aware that it could potentially be a one-way ticket to losing all of your wealth. Investing is about preserving and growing your capital, and it can be very unforgiving at times. A simple but yet very powerful concept to understand is directional percentages. Now, what I mean by that is that for you to lose half of your wealth, it only takes your portfolio to go down by 50%. On the flip side, if you want to come back to where you were previously, your portfolio doesn't have to go up by 50%. No. To come back to where you were previously, your portfolio will have to double and go up by 100%, which is not something that is easy to achieve. Now, I'm not trying to discourage you from investing. Au contraire, I believe that investing is one of the greatest tools that one can use to achieve financial freedom. All I'm trying to say is that it has to be done very carefully, and that bad mistakes can be very unforgiving, which is why I felt compelled to make this video today. By the way, if you have made it this far in the video, first of all, I say thank you so much for sticking with me. If you have found any value in the information provided, if you wouldn't mind just dropping a like for me, I would really appreciate it. Okay, so point number 4 is when in doubt, zoom out. It can be so easy to get caught up in news of short-term nature that you forget why you invested in the stock in the first place. If you are truly a long-term investor, then whatever happens in the short term is just noise. And the God to honest truth is that the stock market just doesn't care about your feelings. You can like a stock, you can love a stock, but you can never marry a stock. Divorce can often get pretty messy. What I'm trying to say is back up your investment thesis by facts. Don't let yourself get influenced by friends, family, and influencers and people like myself. At the end of the day, every single person has a different level of risk tolerance and is in a different financial situation. And so you need to find the best investment strategy that fits your own needs. And yes, that means that you will have to do some research, you will have to take accountability, and think critically about what your investment goals are and what are the steps that you want to take in order to achieve those goals. All right, so my last and final point is the following. Only buy stocks on red days. This circles back to what I was saying previously about being a contrarian, about also not letting your emotions get the better of you. As investors, what do we want? We want to achieve the greatest gains possible for the amount of risk that we are taking. We want to get the best deals on our stocks. We want to save the most money possible. Don't fear a crash, hope for one. Long-term generational wealth is built during market crashes. Easier said than done, of course. If you had to buy a TV and you could buy it at the store for 50% off, would you do it? It's the exact same concept with stocks. All right, so I hope that these tips have brought you some value, and if it did, you wouldn't mind just dropping a like for me. I would really appreciate that. Also, if you are new on this journey and if you have any question whatsoever, feel free to shoot me a direct message on Instagram or simply write something in the comments down below. Thank you so much for watching. I will see you in the next one. Peace out.